Alors bonjour, mon nom est Amélie Ferron-Craig, attachée de presse à la Banque du Canada, et c'est moi qui va modérer cette conférence de presse. Good afternoon, my name is Amélie Ferron-Craig, press officer at the Bank of Canada, and I will be moderating this press conference. So Deputy Governor Kozicki will be pleased to take questions for about 20 minutes, and before asking your question, please state your name and affiliation. So we are webcasting this press conference, so please use a wireless microphone, and we have mostly journalists participating by teleconference today. So we will do one question first, and if we have time, we will go with a follow-up. So the Deputy Governor will be happy to answer questions in both official languages. Alors la sous-gouverneure Kozicki va répondre aux questions des médias pendant une vingtaine de minutes. Et puis, avant de poser une question, prière de vous identifier. Et libre à vous de poser vos questions dans la langue officielle de votre choix. So we are going to start with Tony Mace of Mace News.
Thank you. Hi, Deputy Governor. I wanted to ask you about how you think about financial conditions. How tight are they, and how will it affect your policy decision in January if bond yields in particular continue to decline? Thank you.
Thank you for your question. So in terms of financial conditions have been tightening through the period where we have been raising interest rates. And in terms of bond yields themselves, they have been a little bit more, if you look at the yield curve, a little bit more volatile in terms of some parallel shifts up, some parallel shifts down. In general, of course, we don't look at the day-to-day fluctuations in bond yields, and we think of financial conditions as the mechanism by which our policy is ultimately transmitted to the real economy. So the financial conditions are an input, if you will, into our macroeconomic outlook, and they will matter for the evolution, but they are only one piece of information and one in terms of what's happening. So as I said, it's important for the transmission. The bond yields at longer horizons are often representative of the sorts of levels of interest rates that consumers and firms are facing when they're looking to borrow funds. And so it does matter what those interest rates are, but we're always looking at them in a much more broader context.
Thank you. And we'll now go to a question from Eric Hertzberg of Bloomberg, and after that we will be going to Steve Shearer of Reuters. So Eric, you can go ahead. Sorry.
Hey, good afternoon. I'm curious. I'd like to know what proportion of headline inflation the Bank of Canada estimates as being driven by domestic demand versus global factors. Any thoughts on that?
So that's a really interesting question. What I will point you to is our monetary policy report from October. Because for some people, this, you may not be familiar with this, but we usually give a chart where we give a breakdown of the various factors driving our inflation forecast and also the recent evolution of inflation. And so when you look in that forecast, two of the big pieces that are driving inflation are related to supply disruptions and energy prices. And both of those factors are clearly coming from the global environment. Some factors are going to be hard to disentangle between domestic and global factors because, when you think of goods prices, they're often produced, in a global economy, but there are also going to be domestic factors that are going to affect their prices. So it becomes a little more difficult at times to disentangle the two. So in that chart, since I don't have it right in front of me, I don't have the exact answer in percent, all I'm going to say is a large part, I don't know, maybe roughly a half of inflation is coming from the global factors. And then it's not that the rest is domestic, it's that the rest is a little more difficult to disentangle. Just as one example, in terms of thinking through of the pass-through of high transportation costs from what might originally be gasoline prices into the prices of other goods and services. The extent to which that's passed through may depend on, ultimately competitive pressures in the economy where the goods are being sold. And so that's, again, just an example of why it can be challenging. What we did notice in terms of looking at inflation earlier this year, and we did do a decomposition that we published in July of our our pre-war forecast errors. So our forecast errors of inflation and how things had been revised through time for the first quarter of this year. And in those forecast errors, the lion's share of the forecast errors, because we had not anticipated a lot of the global factors, and they were responsible for roughly 2/3 of our forecast errors. What we also have been pointing out through time is through this year where we've started noticing domestic factors becoming more important, that the excess demand in the economy was really showing up. Now, some of this, it's hard to disentangle a longer-term trend from what may have been a little bit more idiosyncratic. What do I mean? When an economy is closed and suddenly it opens and people want to go out and spend money, that might lead to some pressures on inflation. But whether those are things that persist or ended up being a little more episodic is something that we're, still sifting through. So in the end, the domestic factors have become more important this year. And in the absence of our policy actions, we would have expected those factors to have continued to grow and become more and more important. And that was part of the reason that we thought it was very important to act aggressively earlier this year with our monetary policy actions.
Thank you. And we'll now go to Steve Scherer of Reuters.
Hello, Deputy Governor. Thanks for taking our questions today. You said in your speech that the bank is still willing to move forcefully, and I just wondered if you could clarify that. Does that mean that the bank is still willing to, do oversized moves of 50 basis points or more, or are you referring to sort of the terminal rate to which you think you might bring interest rates?
Yeah, this is one of the risks of talking about hypotheticals is that sometimes it can get misinterpreted as being, the plan going forward. And what I would say is that, we've tried to stress that the change in our communication between the decision that we made in October and then the decision that we made yesterday is that we feel like we've gone from a world where we were trying to decide how much each policy rate increase needed to be, to a world where we're now asking the question of if we need to be increasing the policy rate by more. And one of the things in that context was we didn't want people to misinterpret that language either. And so if there were to be a really large shock, we would be prepared to act forcefully to rein things in. That's the hypothetical. It's the big if world. The world that we're really talking about, though, is a world where, we're talking about if we think we're going to be needing to raise rates, and we'll be looking at all the data and a revised projection in January to come to that decision.
Thank you. And now the next round of questions will start with Mark Rendell of The Globe, then Greg Quinn of MNI, and Craig Lord of Global. So we'll start with you, Mark.
Thanks so much for taking the question, Deputy Governor. I'm wondering how the bank is thinking about labor market tightness as you enter this data-dependent stage. What were the main takeaways, I guess, from the most recent wage and employment data that you've received on that question of how tight the labor market is? And are you still expecting, as Governor Macklem indicated last month, that employment is going to need to rise to achieve that price stability you're going for?
Yeah, so the labor market is clearly an important part of the economy. And we've just received 2 months of data from the labor force survey in a row with increases in jobs. One of those numbers was very outsized. The other number, the latest number, was smaller. When you look over a larger period of time, that data can be really volatile. And so when you look over more like a 6-7 month period, we see that there haven't been a lot of new jobs created on average. That is suggesting there's been some slowing in the labor market than there had been a year ago when we were getting much larger increases in jobs every month. So we're seeing some signs of slowing. But at the same time, we're still seeing evidence that firms are finding it very difficult to find labor and to hire labor. And those difficulties are very generalized. It's not just, a few niche areas with specific skills. It's very generalized. And so that's the sort of sign that we're taking as an indication that, labor markets are still really tight. And so it's not that the labor market itself is what we're dealing with. The labor market is part of the broader economy. The broader economy is in excess demand. That's why firms are having difficulties finding this labor. And so as the economy and as demand slows in response to our policy tightenings, we would expect to see that the labor market also softens. So in that world, yes, we are likely to need to see unemployment rise somewhat in order to achieve our inflation target. But I would like to emphasize, and you can look at our projection from October, or you can wait until January when we have a revised one, but our projection is that, or has been that we're expecting growth in the fourth quarter, first quarter, and second quarter, to be pretty close to zero on average. This is not the sort of really deep contraction that has been seen in recessions in the past. This is, a period of soft to no growth. Sort of, yes, we could get a couple quarters slightly negative. We could get a couple quarters slightly positive. And that's really what we're seeing right now.
Thank you. We'll now go to Greg Quinn of Market News.
Bonjour, Montreal. Hi, it's Greg. If I wanted to go back to the thinking on yesterday's decision. If you're now on the fence about hiking rates again, I'm wondering why you moved a half point this time as opposed to taking the smaller 25 basis point increase, potentially to avoid an over-tightening risk.
So the context in which we made the decision is we had clearly already made quite a bit of tightening. We raised rates quite a bit already prior to this decision. We felt like we were in a world where we still have high inflation. We still have high short-term expectations of inflation. We still have evidence of excess demand. And yes, we are seeing some evidence of softening in demand. And so when we put all of that together, the fact that inflation is high, the fact that expected inflation is high, is, for us, a reason to be taking the exact decision that we did take, was 50 basis points. But we are also cognizant of that we're in a world of uncertainty. And so as we go forward, that's why we've said, we're moving to an if we need to move by more, and also that, we'll be very data dependent in evaluating that.
Thank you. We'll now go to Craig Lord of Global.
Hello, thanks for taking our questions, and perfect segue on your last comment there. You have said that you will be more data dependent going forward on if you need to raise interest rates. Can you just clarify how the approach is changing from how you would have interpreted data throughout much of 2022 and how you'll be interpreting it going forward, or is there different data you're looking at? Can you kind of help explain that data dependent comment a little bit?
I think it's not so much a signal that our approach is changing, it's that we're in a different situation. So what do I mean by that? When inflation is very high and rates are very, very low, think back to where things were in, say, March, it was pretty clear what direction rates needed to go. And so we were on the margin trying to think about how large the increases should be at any given meeting. That was more the context of the environment we're in. So the environment we're in now is an environment where rates are much higher, where inflation, has come down a little bit in the case of CPI inflation, largely because of energy prices. Some evidence on core inflation, when you look over 3 months, that things are actually coming down a little from, compared to a 12-month core inflation rate of 5%. A 3-month rate is closer to 3.5%. So, that's suggesting things are coming down. Some evidence the interest-sensitive sectors of the economy are starting to slow. So that's putting everything into a very different environment. Now, that environment still has inflation higher than we want it, and it has short-term expectations of inflation, higher than we would like to see. And so when we pull all of that together, we're using the same tools. We're still, discussing the evolution of the economy. We're still bringing as much data as we can into our decisions. We're, still very much appreciative of, all of the participants in our outreach efforts, or I should say in our surveys. So be it our Business Leaders Pulse or our Business Outlook survey. All of that information is always valuable every time we're making the decision. But the big difference is where the starting point is for making that decision. And the difference is that we're starting to see signs that our past tightenings have taken action, and we've already taken a lot of actions ourselves in raising the interest rate. And so in that world, the data dependence is signaling that we're very interested in seeing, again, how the economy responds and continues to respond to the actions we have taken. Earlier, it was sort of obvious the direction we needed to go in. And so in that sense, that language of data dependence, it's true. Our decisions are always data dependent, but the direction was already obvious. And that's why we've changed the way that we're using the language.
Thank you. We'll now be going to Ian Bickus of Canadian Press.
Thanks for taking my question. You mentioned in the speech it's a challenging time for Canadians. And I'm just wondering kind of what level of stress you're willing to endure for household stress to get to that 2%, or what kind of triggers might cause you to reverse the rates if bankruptcies or delinquencies rise well before you get to that target. Will you consider a reversal?
Okay, so I had some difficulty hearing your question, so I'm going to repeat what I think you are asking. And I think you are asking, what sorts of things are we looking at to know when we might lower rates, and information related to hitting the actual target itself. Is that correct?
Yeah, especially around what might cause you to reverse rates, just overall how much household stress are you willing to endure?
Oh. Okay, so yes, that time I heard the word household stress in there as well. So when we're taking our decisions, we're not just looking at macroeconomic data. As I've referred to a lot of the data that we're looking at. We're also really trying to appreciate what's happening at the household level. So, it could be across different income levels of households. It could be across, different indebtedness, where the thing that we focus most on is the housing market indebtedness, because we know there are different types of contracts on the housing market. We know that there are 5-year fixed rate mortgages, variable rate mortgages, and we have very good anonymized micro data to give us a sense on that. So we really keep our eye on that because that helps us understand how our actions are feeding through the economy. And so it helps us understand how much, if a household faces a higher mortgage rate, how much might that impact their consumption, right? So we're really trying to keep an eye on all of those things to get an assessment of what's happening in the economy. And, that helps inform our overall view on what's happening on the macroeconomy, what the outlook for the economy is, and importantly, what the outlook for inflation is. Let me go back to some of those individual households. When individual households are paying higher mortgage rates, we understand that this is really, really difficult on those individual households. From a broader macro point of view, what it's signaling is they're probably going to be cutting back on some of the other spending. And that's an example of a reduction in the demand that is going to help allow the supply to expand to catch up with where demand is. So we're looking at the households from that point of view to try to understand how things are going to go. In the end, we have to take our monetary policy decisions for the whole national economy. So as I said, we do try to look at what's happening at households in different points of view. We look across industries, we even look across provinces. All of that helps inform our picture, but we're taking our decisions on a much more aggregate basis because in the end, it's about achieving our inflation target, which is, the Canadian inflation rate, and we only have that one instrument. We can't target different segments of society. So I think that was the lion's share of your question. If I missed anything important, then I think we may have.
That's helpful, thank you.
Okay, thank you.
So we have time for one last question, and we'll go to Stephanie Hughes of the Financial Post.
Good afternoon. Thank you for taking my question. You've observed that food inflation is staying high even as commodity prices have come down. What role is food industry concentration playing in inflation? Because of their size, are Canadian companies insulated from competitive pressures to keep a lid on prices?
Yeah, so, one of the things that we've observed as costs were going up, and this goes all the way back to wheat prices going up that feed through to flour prices, that feed through to baked goods, just as one example, but that's happening very broadly. Transportation costs to get, raw materials to food manufacturers and then to get, more of the processed foods to the grocery stores. Transportation costs have gone up. A lot of costs have gone up. When we look at the data, we found that, the costs are going up and those costs are being passed along to prices and passed along quite rapidly to prices. We're also seeing, when we looked at things that, profit margins in this sector, hadn't really been moving much. And as we go forward now, we've already started to see declines in some of these costs, and we will be watching closely, to see what happens to some of these other prices. More generally, as economists, we tend to think that as demand eases off, then you tend to be in an environment where businesses become a little more concerned that, they can just automatically pass everything along, or maybe even mark things up a little more. That's behavior that they can't do when you're not in excess demand. And so, we'll be watching for, more competitiveness pressures as being something that helps keep prices from rising more rapidly. In terms of other issues that, are more related to concentration and things like that, that's something that I'm going to leave to other areas in government to examine. I think from our point of view, we just look at what we can in terms of input costs and output prices and try and get assessments of where the economy's going and where inflation's going.
Thank you. That's it for today. Merci beaucoup.